let me welcome on board Shrikant Chouhan, who joins us on the show as well. Shrikant, a couple of these spaces are doing well today. A is, of course, defense on account of that DAC news. So those data patterns and Bharat Dynamics of the world have been doing well. Garden Reach, Cochin Shipyard. And a couple of these cable companies, case in point being, of course, KC International, which is, has a bit of a exposure to infrastructure and transmission, and Finilex Cables is doing well. What's your take on some of these names?
Yeah, good afternoon, everyone. I think, see, in that particular all these stocks, if we just go through with few of them, then case is doing really well. It is like whenever there is rally in the stock, prior to that we see consolidation, and most of the time that consolidation manages to hold above the lowest of the previous week, which is something clearly indicates that not only the technicals but also fundamentally the company is very, very strong. And while looking at the overall setup of the stock, I am of the view that the stock is heading for at least 1500 in next maybe few weeks or months. So it will take some time, but it's a positional buy at current levels. I think the stock is having very good support close to 1050. So in case if there is any correction, then we should look for adding more close to 1050, 1060 levels. We also like phenolic cables, and there also we are seeing that some amount of buying interest is there after falling to the extreme levels from the highs of 1680 to almost 1100. But the rally which was there in the past was much, much stronger. And the correction, the sell-off that we saw from the highs was the corrective pattern. So again, I'm expecting strong bounce back or pullback to the recent fall, and the stock can again manages to move to the levels of 1500 or maybe 1550. So broadly, I'm of the view that the correction that we are seeing right now, or maybe the sell-off, or maybe the fall that we are seeing in stock, is nothing but corrective pattern to the previous rally that we saw in the past.
Point. Dipan, what about the PSU banking space? Because we were just going through the data this morning as to when, Bank Nifty is up almost 5% since November 21 lows. You have the PSU banking index, which is up almost 10%, and that comparative data will come up for you on the screen. Do you think this sort of outperformance from the PSU banking space will continue purely because they had taken a bigger knock as well? Dipan, the question is for you. Okay, I think we'll just toss that question to Naresh at the moment as well. Naresh, what within PSU banking names looks good to you?
So all the names have actually given a breakout today. So you have State Bank of India trying to break out above the 860 mark, not far away from the all-time high at 900, 910. Then you have Bank of Baroda, which went through all sort of volatility over the last 1 month. Gave a breakout post numbers, went to 265, did a low of 230, and now we are back to 260 levels. So that's the one. But I would continue to have a basket approach out here on the PSU bank. So something like PNB, Bank of India, which have corrected 30% from the top and are now reversing. So that's one segment. And then SBI itself. So SBI and a bunch of small cap PSU banking names still look interesting.
Okay, point taken. Dipan, let me toss that question to you. PSU banking space, which are the names that you like?
Yeah, I think if you have a little bit of appetite for risk, I was very impressed last 2-3 quarters, banks like Bank of Maharashtra, Central Bank of India, Punjab and Sindh Bank, some of the other tier 2 banks have reported very good numbers. And now their kind of growth dynamics, all the numbers, whether it is credit growth, NPA, all the other aspects, fee-based income, that is very close to some of the new generation private sector banks. But yet these banks are trading at a massive discount in terms of price to earnings and price to book. And I think that they are now in a position to steadily grow their balance sheet. They anyway have a very strong network of branches. Their CASA ratio also is very high, which provides them with low cost deposits to lend as well. And a lot of the constraints which are holding them back in terms of high provisioning required and adequate capital adequacy, I think those issues are well behind them. They have invested extensively in technology and improving their service levels, although not at the same level as private sector banks. But I think that there's definitely an opportunity in the PSU banks. But I mean, nonetheless, also, you could still look at SBI, and that also, I think, if you have it's got a good risk return profile, I would say, within the entire banking space.
Okay,
Let's just take stock of what else has been holding up. RBL has shot up quite nicely today. It's holding up a good 5%. There's Indian Bank, which is looking good by about a good 5.5% as well. And then, of course, there's HDFC Bank, which continues as a steady ship. From the tier 2 banks within the private lot, Naresh, what's looking good to trade?
So it's always been Federal Bank, which has clearly been the leader, continues to make new all-time highs even today. But the other names are now giving a very interesting signal in terms of bottoming out. So if you look at RBL Bank, it has corrected from 300 all the way down to 150 and bottomed out. You have Bandhan Bank, which is closer to the lows it made in March 2020. Then you have IDFC First Bank, which has corrected even after the recent recovery. It's still down 30-35% from the top. So basket of these private banks which have corrected 30-35% from the top and reversing could be interesting. And the very small one, which is DCB Bank, which has clearly given a reversal signal. So that is one more name in the whole basket. So you have a bunch of names out here, and all of them look interesting.
Point taken. Time now to take the closing trade ideas from our technical experts. Shrikant, you go first.
Yeah, I think this market is like showing a lot of broad-based activity in this market, and whenever there is a broad-based activity, we see a good amount of buying interest in those stocks which are not the part of index, and in that way, like Zomato, yes, it is entering into Sensex, but while looking at the setup of the market, I think it is on the verge of crossing its previous high of 300. At this level, it is consolidating, and the support levels are at around 275 to 77. So with the same stop loss of 275, we should look for adding Zomato at current levels. We are expecting stock to move towards 300 and maximum 310. Apart from that, we also like Punjab National Bank, and here if we see the overall technical pattern of the stock, then it is much better, relatively better than other banks. In that, we are expecting stock to move towards at least 116, 117. Currently, it is at 110, and we can keep stop loss around 108.
Okay, that's the trade coming in on PNB. Naresh, what are your stock ideas?
So that would be a buy on ICICI Bank. We've seen the stock again testing that 1300, 1320 mark. Should be a short-term breakout in play, and post the breakout in HDFC Bank. Next one on the radar would be ICICI Bank to make a new all-time high.
Dipan, good to have you on the show. We'll let you go on that note. Thanks as always for your time.
Well, the market is holding out all right. Pretty much in the green right now, close to the 24,550 mark. Okay, that's a gift Nifty 24,450 right now, off the highest point of the trading session. But it's not all about markets. It is about what's happening in the box office as well. And you know what? Thursday is the new Friday because we have Pushpa 2 releasing tomorrow. That one has seen quite a bit of, bookings as far as the pre-openings are concerned of that. The premiere show is already sold out, as far as Mumbai is concerned and a lot of parts of the country. So let's try and understand better whether that would be able to revive the fate of the likes of PVR Inox or not. Karan Tarani, the Senior Vice President at Elara Securities, joins us on the show right now. Karan, hi, good to be speaking with you. Well, the street clearly is very excited about this one, but any, estimates that you have penciled in as to what the box office collections can be of Pushpa 2.0?
I think in terms of Pushpa 2, it's going to be a very strong opening. This is a very large franchise film, with a very strong recall value. Pushpa 1 had done, collections of somewhere close to about 400 crores net box office across genres. And it was a mega blockbuster and a super hit. So because of the entire franchise recall, the opening is going to be extremely strong. I think we should see numbers of anywhere between 150 to 160 crores of net box office revenue on the first day, and potentially the weekend net box office revenue across genres, which is the dubbed and the Hindi version, could be almost about 450-500 crores. And in terms of lifetime, the movie could do anywhere between 900 to 1,000 crores of net box office on domestic. So clearly, I think a lot of buzz for Pushpa. And this is going to be a big respite for exhibitors in terms of occupancy levels in the month of December.
Right. Karan, we've seen a good theatre release, in fact, a series of them over the past couple of months. Do you believe that we could see a resurgence in the footfall back to pre-COVID levels, or do you still think that OTT is going to steal the show?
So, we think that, OTT platform, the entire threat around that is very much here to stay. I think 10 to 15% of the occupancy levels is the reason in terms of the OTT impact which is there, which may never come back on a consistent basis. So on certain quarters, we may see that occupancy levels are going back to pre-COVID levels, but on a consistent basis, on an annualized basis, occupancy levels coming back to pre-COVID levels or rather moving ahead of pre-COVID levels is a challenge because of OTT. So I think OTT risk is very much there in terms of the valuations, in terms of performance, and in terms of our estimates as far as growth is concerned. The bigger KTA we heard is that large budget films need to do well on a consistent basis because the dependence on large budget films is very high, for the exhibitors. And if you look at the recent past as well, I think the month of October was quite muted. November, we saw some respite because of Diwali releases. Both the films did reasonably well. They were not blockbusters, but they were above average performances, and they garnered about 500 crores of net box office. So clearly, I think large budget films need to click well on a consistent basis. If occupancy levels need to go back to pre-COVID levels on a consistent basis, I think for occupancy levels to move beyond pre-COVID levels is a tough ask for now because I think small, medium budget films are not doing well on a consistent basis. A lot of content is there in terms of variety for the audience to watch on OTT, which was not there in the pre-COVID times. So I think on a consistent basis, in a best case scenario, we could end up at occupancy levels of 28-30%, which is about 10 to 15% lower versus pre-COVID level on an annualized basis.
Yeah, not sure if that 28-30% kind of occupancy level is good enough for a stock like PVR. What's the recommendation then?
So, in terms of a target price, we have a target price of 1950 for the stock, and we believe that really valuations comfort is very much there. If you look at the valuations on a in EV/EBITDA basis, on pre-index EV/EBITDA rather, so I think the valuations are somewhere around 10 to 11 times, and historically this company has traded in a band of 13 to 14 times. So I think there is a reasonable amount of potential upside of 20-25% over the near term. But clearly why this is not happening is because the performance has been volatile over the last 3 to 6 months. CY23 rather was a very strong year in terms of films. We saw Gadar 2, we saw Pathan, we saw Oh My God, and we saw Ranbir Kapoor's Animal, which did well. This year, categorically, Hindi films have not done well in terms of large budget movies. The number of films are slightly lesser as compared to what they were last year in terms of the number of films doing well. And Hollywood content has been a major setback. So I think going ahead, two trends are going to emerge. We will see a lot of catch-up, of large Hindi films next year in CY25. A lot of the large stars like Ranbir Kapoor, Ranveer Singh didn't have too many films this year in CY24. So CY25 will see release of large star budget films which are there in Hindi genre, which will show some kind of respite. And also the Hollywood Writer Association strike has led to a consistent delay in terms of large English releases. And English genre contributes about 20% of the box office revenue for PVR Inox. So I think CY25 we will see respite because of franchise, Hindi films, which are, sequels and other things put together. And the Hollywood side, you'll see multiple large scale films releasing as well. So these are some tailwinds which will probably help, occupancy levels breach towards that 29-30% mark on a consistent basis.
Right, Karan, good to have you on the show. Thanks for that quick analysis on not just Pushpa 2, but whether or not we're going to get back to those pre-COVID footfall levels or not. Ajay Bagga as well joins in on the market. Ajay, let's talk about the movie exhibition space. While of course it's a monopoly out there, but does it seem like it's not going to get back to its heydays as it were the case post we all discover OTT?
Well, from a consumption viewpoint, it's a good sector, but it's just too small, as you mentioned, very small really to track, and it's a one pony sector. So overall, the trends are against the sector in terms of OTT taking up most of the space. You need blockbuster movies, and all the what we are seeing, the news around Pushpa 2 will lead to some amount of froth in particular stock. But overall, we have got a lot more consumption plays, and you don't have too much choice in the sector as such. But the trend globally is towards OTT grabbing more and more of the market share.
More and more of the market share, that of course is something that one needs to watch out for. But just taking stock of what else is happening in the market right now, you do have the likes of HEG and Graphite India doing quite well for second straight day. KC International is up now 11%. We just spoke with the management, I think this week itself, and the management sounded fairly confident about their growth roadmap. We'll try and pull up a soundbite from that one. Honasa Consumer is sitting with decent amount of gain. RBL Bank, Aisha just pointed out. You also have a Macrotech Developers which has suddenly spiked 6%. Ubra Realty has been doing well, 4.5%. Ajay, over the last couple of days, we have seen some fresh initiations on the real estate company. UBS did on the entire sector yesterday. Today, Nomura on Ubra Realty. What's your take? Time for a fresh relook at the real estate pack, or they are adequately priced?
What has happened is that over the last 3 years, post the peak of COVID, we have seen real estate do very well. I would say priced quite well already, priced to perfection. So very difficult to really justify. Of course, when new luxury projects come in and you see everything getting sold very fast, then you tend to look at the sector afresh. But I would say you're better off in the industrial infrastructure space, in the construction space, in the implementation part of the infrastructure business than these real estate majors. They have cleaned up the balance sheets. The good news is with good regulation and smart moves, all these companies which have survived are the real winners, and they will be multi-year winners. But valuations becomes an issue, and behind the headlines, if you see, it's more that people have committed money partially. All those kind of things are behind the headlines. But given all that, there is a big demand at the upper end of the market, and most of these players are in that. We have seen some South-based players showing not so good numbers and not having that many approvals in place in various states. So, it's not a very similar pack. I think North-based players are much better off. We have seen NCR prices going up and projects running very fast. So you have to look at the balance sheet. You have to look at the kind of projects they have in hand and how soon those will be coming onto the P&L. Those are the issues, and I would say that you're better off on the industrial infrastructure capex side of the business, or even on the cement place rather than the real estate players at this part of the cycle.
Okay, point taken. So that's the view coming in on the real estate stocks. You know what, we're watching out for the OPEC meeting tomorrow. The expectation is that there will be, some action there, and the RBI MPC meet, of course, is underway. We'll get you the previews on both of them, and we'll get Ashesha as well as Gaurav to join us to talk to us about the expectations. But before that, let's hear out what the KC management had to say, because that stock is up 11%.
Order target has been around 25,000 crores. And we have now touched around 16,300. So the balance, roughly around 9,000 crores, should be coming in Q4, or from now onwards till Q4. We already have an L1 of around 6,500. So I do expect that Q4 would be better. 15% at 20,000, I think, is a good target. I am not sure whether we'll be able to exceed it. But with these orders, what will happen is that our next year's growth also, today our order book plus L1 is around 42,000. So with this, I think we expect that next year also we should do another 15%. If you add 15% on 23, we'll probably be around 26, 27,000 crores next year. We have been talking about a 9 to 10% margin in FY26. So whether it would be 9 or 10, difficult to predict today, but it would be closer to 10, I think. Or that's our hope. We hope that we'll touch 10. But 9 to 10 is definitely a target which we have set out for ourselves in FY26. FY25, we have maintained that by exit, we should be around 9 to 10%. That's how we'll be 9 to 10 in FY26. For FY25, we have been talking about 7.5%. I'm hoping that we will be able to meet the target of 7.5 for the whole year.
Okay, so that's the take from the KC management. But as promised, let's hop across to Ashesha to get a better sense as to what the expectations are from the OPEC Plus meet. Ashesha.
Well, yes, all eyes are on OPEC Plus meeting, which is scheduled to happen on the 5th of December. Remember, the meeting was originally scheduled to happen on the 1st of December, but was later postponed. And the main agenda of the meeting is to review supply for 2025. Now, the expectations are that production output revival, which was scheduled to happen earlier this year, will be revised yet again, will be delayed yet again for another 3 months. The output revival of about 1,80,000 barrels per day was expected to happen from January 2025, but it is expected to be delayed by another 3 months. So all eyes on OPEC Plus meeting. Remember, demand continues to be a challenge for global oil market. China is the biggest consumer and importer of oil, and slower demand from China is one of the main reasons why oil demand globally is a concern. And apart from that, apart from OPEC Plus, other countries are also reviving and increasing oil in output. So those are some of the reasons why demand continues to be a concern. But all in all, expectation is that perhaps oil production revival is expected to be delayed by another 3 months, and all eyes on OPEC Plus outcome, which is expected to come in tomorrow.
Okay, Ashesha, we'll leave it at that. Well, there's also the crucial MPC meeting which kicks off today as India continues to face the elevated inflation and softness in growth. The committee is largely expected to hold policy rates and maintain their stance, but the focus this time is going to be on liquidity management, according to experts. In fact, Gaurav joins in to tell us what his poll of bankers and economists is penciling in.
Well, yes, RBI MPC meeting has begun, and let's rewind and see what has happened between previous RBI meet and today's RBI meet. We have already seen two big events happening. So first, let's talk about CPI, which actually crossed that 6% mark and also was at a 14-month high level in the month of November. And at the same time, when we talk about GDP growth, for second quarter, we saw the GDP growth was slowest in the last 7 quarters. The GDP growth came in at 5.4%. So given all the factors, now the question remains is that during this meeting, can we see a rate cut? Now, experts believe, around 81% of the experts believe that we will not see any kind of rate cuts even in this meeting. And the reason being that RBI may focus on the inflation, because when we talk about inflation, 2 to 6% was their resistant band, and inflation has already crossed that 6% level. So experts believe that RBI will still remain constant on what they have said. They will keep the rates unchanged for the 11th consecutive meet. Apart from that, when we talk about the growth, experts are expecting some kind of push coming up from RBI in terms of growth. So when we talk about growth, interest rate is not the only tool. What RBI can do is that RBI can tweak the CRR ratio, which is cash reserve ratio. So when we talk about this ratio, before COVID, this ratio used to be at 4% level, which was raised to around 4.5%. Now experts are believing CRR ratio can be cut down once again to 4% level. They're expecting 25 to 50 bips cut in CRR ratio. What it will do is that it will actually give some kind of boost in terms of liquidity for the banks, and that is the reason why experts are expecting some kind of changes in CRR ratio. Other than that, any kind of commentary coming up from the GDP and inflation angle is going to be crucial, because when we talk about both the numbers, we have seen actually numbers are actually missing what the RBI had estimated. So we can see some kind of tweaking happening in the estimates as well. Other than that, any kind of commentary in terms of the dollar strengthening, any kind of commentary which is coming up on the geopolitical events will be something to be watched out for. And lastly, let's also not forget that RBI's governor, Mr. Shaktikant Das, is going to end his term on the 10th of December. So any kind of commentary coming up on this angle, is he going to extend his term, is also going to be something which is going to be crucial for the commentary. But overall, when it comes to rate cuts, experts are not expecting any kind of rate cuts, at least in this meeting from RBI.
Not expecting a rate cut, but let me toss it to the expert on the panel. Ajay, you track the macroeconomics very closely. With the kind of GDP print that we got and the kind of setup that we have at our hand, is there any possibility of a rate kind of action? And more importantly, what's your own sense as to the RBI governor? Do you expect him to extend his term? Are we perhaps likely to see a new face? Anything that you are hearing?
Well, the money markets would like him to extend his term. He's had a pretty spectacular term, and he has been consistently ranked among the top central bankers world over. But there is a tradition that governors change. So I think there will be a change happening, though the markets would prefer him to stay. In terms of expectations on the rate cuts, those have moved to February largely. earlier part of this year, we were expecting that the rates would start getting cut by October, following the Fed cutting by August, September, and that got postponed. Now, the dilemma for the RBI is twofold. One, how to ensure that the rupee depreciation is orderly. They have to keep an eye out for competitive devaluation that the Chinese will be doing, Southeast Asian nations will be doing continuously. That's the Chinese rebuttal to Trump tariffs. We have seen that happen in 2017-18, and already the Chinese have smartly depreciated their currency. So the rupee has to be competitive in export terms, but it imports inflation if it's disorderly. So the RBI is in a bit of a cul-de-sac where, on one side it has to protect the value of the rupee, on the other side price stability, and third is the growth imperative. The growth has slowed down, and you need counter-cyclical measures both on the fiscal and monetary side. The money market is telling you that with the kind of fall that you have seen in the yields, right from the 40-year paper down to the 5-year paper, and the OIS is showing that a rate cut is anticipated by February and April. So I think if on Friday we don't get a cut, you will get a 50 basis point in February probably. Second would be on the liquidity. The street seems to be quite convinced on a CRR cut. Let's wait and watch. That's again a very blunt instrument. RBI doesn't like to leave that on the table mostly, and rather they prefer OMOs and variable auctions. To ensure they inject liquidity, but it will be a good signaling. If they give a CRR cut, it will help the balance sheets of banks as well. More liquidity and better margins, both will be welcome for the banks. Markets have run up in anticipation. So we'll see on Friday, but it's a tough position to be the RBI governor this meeting between the growth stalling and inflation still being very disruptive, and the third being the protection of a orderly rupee depreciation.
Okay, stay on with us, Ajay. Lots more to talk about, but I'm going to quickly take it back to our chartists and get in some BTST trades as well before we, move on. Naresh, what's on your list?
So first is the buy on ICICI Bank, a leader stock. We're looking at towards a breakout. Stop loss at 13.05, target price of 13.45. Second is a buy on LTF, L&T Finance, which has corrected a lot and is now showing a reversal signal. Stop loss at 146, target price of 153.
Shrikant, what about your BTST trades?
Yeah, I think after this fall, we are seeing good amount of buying interest in number of stocks. In that, real estate stocks are doing well. KECs on which just now we discussed is very close to its upper circuit, and Kolpal is showing some strain. Currently, it is around 2920, 2925 levels, but after correcting to the levels of 2850, it is reversing back. While looking at the overall setup, I think it is heading for the levels of at least 3000, 3050. So Kolpal is a buy at current levels with a stop loss close to 2870. And from the cash segment, we like Prism Johnson, which is around 194, 193. The stock has made a multiple bottom close to this 185, 186 level. And from the current level, the stock can move to the levels of 210 or 215. So it is very close to its breakout level. It's a buy at current levels around 194, 195 with a stop loss at 188 on the downside.
Okay, point taken. So those are some of the top recommendations coming in. Ajay, I'm not sure if you track, of course, the Adani Group closely or not, but would you have any recommendations on the Adani Group?
No, particular stocks I would not like to talk about.
As far as the other bits are concerned, this entire BPC category and the overall urban retail and consumption category is something that is coming back to the radar. We were just speaking with the management of DLF Retail as well as to how the Black Friday sales have picked up quite massively. What do you make of this theme?
No, see, overall aggregate demand has come down in the economy. We have seen that with the GDP numbers, and stocks have not performed so well. The expectation now is some counter-cyclical measures. will the government wait for the budget to come in? And on the other side, will they release big chunks of payouts for projects as well as welfare schemes? That's what needs to be watched out. The Indian consumer, the Indian taxpayer has done their bit by raising the GST levels or the direct tax levels. Corporate tax has not been that good for October, but we'll have to wait and watch the December 15th number. That will give a very good idea of the tax collections. But what we have to really wait for is government disbursals to pick up, and that will then see all the consumption themes picking up strongly. The sowing has been good, and we are expecting rural demand to also start picking up. But a lot depends on the government spending coming in. We lost about 4 months in the beginning of the year. There is that catch up happening. We will not meet the infrastructure capex number for the year that was budgeted. So the government will have a good 50 to 75,000 crores extra in hand, which if they can, dole out between now through February, that can be a good counter-cyclical boost into the economy. So we have to wait and watch for that. There are some segments which are looking very good, and they have also caught the attention of institutional investors like quick service commerce and platform companies, which you were discussing earlier. I think those are looking good and they should do well. But right now, I would say public sector, railways, defense. Railways, defense, I have been talking against from about May onwards on valuations. But this is the pre-budget time. You have a 60-day window to get into public sector, railways, defense. They normally do well going into the budget, and then we see a tapering off post the budget. So might not be a bad idea for short-term investments to look at these three: public sector, railways, and defense. A lot of overlap in these three. A lot of them are also public sector companies, but public sector, I think the banks got hit too much, and with the RBI action upcoming, you will see benefits on the treasury as well coming to them. The way the yields have corrected over the last 1 week has given them some boost on the treasury income as well. So I would look at public sector banks as well, along with railways, defense. Again, it's a 60-day trade. Going into the budget, you will see the normal frothiness coming into all these sectors.
Okay, great to then have you on the show, Ajay. We'll let you go on that note. Good speaking with you as always. Naresh, Shrikant, both of you as well. Thank you.
If you like this video, then like, share and subscribe to ET Now.